Hey, the learner, and welcome back. I know you're all about getting to the heart of things without a lot of fluff, so we're diving deep today into some serious wisdom, and it's coming straight from a legend,
We're talking Warren Buffett, of course.
of course. Specifically, we're looking at essays of Warren Buffett, insights for investors and managers.
Oh yeah, these essays, pulled from his famous letters to Berkshire Hathaway shareholders, they're like a masterclass in investing in business thinking.
Exactly. And whether you're managing your own portfolio or leading a team, the insights here can really make a difference. We're going to unpack the core principles that have made Buffett so successful.
We'll be going beyond the usual financial advice, getting into those unique perspectives that make his approach so fascinating, so effective, honestly.
So let's get right into it. You know how so much of investing revolves around this idea of risk, and often beta is used as the main way to measure it.
Right.
Well, Buffett has a very, let's say, unconventional way of looking at risk, and especially at this whole beta thing.
Oh, absolutely. He kind of turns the traditional thinking on its head. The idea that a stock that's dropped in price is inherently riskier than one that's soared just because of its beta, that historical volatility compared to the market.
Yeah.
Buffett really challenges that.
He's like, hold on a second. The biggest risk is paying too much for any asset, regardless of how it's bounced around in the past.
Exactly.
He has this brilliant, almost funny way of making this point. He talks about single product toy companies. Like, imagine one company making pet rocks and another selling Barbie dolls or those classic rich uncle board games.
Oh, I see where you're going with this.
Beta wouldn't tell you anything about the vast difference in risk between those two businesses.
Not at all.
But just by looking at those products, just by understanding consumer behavior a little bit, you can probably tell which one has a better shot at lasting.
Absolutely. And that's Buffett's point. It's about understanding the business itself, its long-term viability, its competitive position, the people running it. That's far more important than any mathematical formula.
So basically, forget obsessing over beta coefficients and spreadsheets and get back to the basics of business sense.
Precisely. For long-term investors, being generally right about the big picture is way more valuable than getting caught up in overly precise calculations that miss the forest for the trees.
Right. It's about thinking like you're actually buying a piece of that business, not just a ticker symbol. Now, let's talk about another investment principle that Buffett seems to, well, disagree with. Diversification. You know, the classic, don't put all your eggs in one basket idea.
Yeah, well, Buffett's view on this is really interesting. He actually challenges this core idea from modern financial theory. He doesn't advocate for spreading your investments as widely as possible. Instead, he leans towards concentrated investing, at least in terms of how you think about your investments.
Yeah, that definitely goes against the grain. So why does he think that way?
Well, he points to John Maynard Keynes, who was not only a brilliant economist, but also a savvy investor. Keynes believed in focusing a big chunk of his capital on just a handful of companies he understood deeply and really trusted. And Buffett seems to agree with this approach.
So if we think about Buffett's philosophy of really knowing what you own, it starts to make more sense. You're not just blindly throwing darts at a board.
Right. In fact, he argues that having too many investments, being over-diversified, can actually increase your risk.
And that sounds counterintuitive.
Think about it. If you're invested in dozens, maybe even hundreds of companies, can you truly do your homework on each one? Can you be confident in every single holding?
That's a great point. If you have a limited number of investments, you're almost forced to get to know them inside and out, good and bad.
Exactly. And for Buffett, focusing on a few businesses that you understand and believe in reduces risk because you're making more informed decisions. You're not spread too thin. It's like that Mark Twain quote, put all your eggs in one basket and watch that basket.
Watch that basket. It makes sense. So less is more, as long as you truly know those less. Okay, now let's talk about something that eats away at returns over time. Trading costs.
Yes. This is where Buffett gets really colorful with his analogies.
Yes, he does.
He compares frequent traders to people who jump from one fleeting relationship to another. They're constantly chasing that initial excitement, but never building a real, lasting connection.
In this case, a connection with the businesses they're invested in.
Exactly. And the problem is all that buying and selling comes with costs. Transaction costs.
Which might seem small individually. We're talking about the bid-ask spread, those tiny differences between buying and selling prices, plus brokerage fees, commissions, and of course taxes on any gains.
And those seemingly small costs add up really quickly. Phil Fisher, another great investor, made a similar point, comparing a good business to a restaurant with a well-crafted menu. If you're constantly changing your order, adding dishes, sending things back, those extra charges are going to eat into your enjoyment.
Right, you end up paying more for a less satisfying meal.
Exactly. And Buffett estimates that these hidden costs, broker commissions, and the spreads can eat up 10% or more of a company's potential earnings over time. That's a huge drag on performance.
10%, that's significant. And Buffett makes it clear that he wants Berkshire's stock price to reflect its true value, not be driven by a bunch of speculative trading.
Yes, he contrasts that with managers who prioritize high trading volume, maybe thinking it makes the company look more exciting. But Buffett emphasizes long-term thinking, encouraging shareholders to act like owners, not short-term gamblers.
Right, owners who care about the long-term health of the business. Now, acquisitions are a big part of Berkshire's story. What are some of Buffett's insights on buying companies?
Buffett has a very specific philosophy, especially when it comes to those high-premium acquisitions. Those deals where companies pay a lot more than the current market price.
Right.
He says there are really only two rare cases where a big premium might make sense. First, when the business itself is so fantastic, so inherently profitable that even mediocre management can't mess it up.
Okay, so an amazing business that practically runs itself. What's the second case?
The second case is when you have incredibly talented managers who have a proven track record of turning around struggling businesses. They're the kind of people who can unlock hidden value that others might miss.
So very specific criteria there. What about the majority of acquisitions, the ones that happen all the time? What drives those?
Well, Buffett's a bit cynical here. He suggests that three main motivations often lead to bad acquisitions.
Let's hear them.
First, there's the ego boost that managers get from doing a big, splashy deal. They want to be seen as deal makers.
Ah, the thrill of the chase. What else?
Second, they like the idea of running a bigger, more complex company. It feeds their ambition.
So bigger isn't always better, at least not for the shareholders. And the third reason?
The third reason is often an overly optimistic belief in synergies. That magical idea that combining two companies will automatically create more value than the sum of their parts.
But that doesn't always pan out, does it?
It rarely does.
So often, it's about managerial ego and wishful thinking rather than solid logic. What about when Berkshire uses its own stock to buy companies? That's a pretty valuable currency.
Oh, Berkshire's extremely careful about that. They'll only use their stock to buy a company if the value they get is at least equal to, if not greater than, the value of the stock they're giving up.
They don't want to dilute their own value.
Exactly. Buffett uses this great analogy of the Louvre. If you already have a collection of masterpieces, it's hard to find another one that really adds to the overall quality. You wouldn't trade a Rembrandt for something mediocre.
No, you wouldn't. So the bar is set very high for acquisitions using Berkshire stock. What about the sellers in those deals, the ones getting Berkshire stock? What does Buffett want them to consider?
He stresses that sellers often get caught up in the current market price of the buyer's stock, rather than looking at its underlying intrinsic value.
Which can be very different.
Right. If the buyer's stock is overvalued, the seller might think they're getting a great deal, but they could be receiving less real value in the long run.
So understanding the true worth of both sides of the transaction is crucial. Now, let's shift gears to something that can be a real headache for investors: financial reporting.
Oh, yeah.
Buffett has some strong opinions about how companies present their numbers.
He does. He often complains about how GAAP, generally accepted accounting principles, can make it hard to understand the true health of a company.
Because sometimes it feels like you need a PhD in accounting just to decipher those financial statements. What are some of the things that bother him specifically?
Well, he came up with this idea of look-through earnings to address a specific problem with GAAP. So under GAAP, if you own more than 50% of a company, you fully incorporate its financials.
Yeah.
And between 20% and 50%, you typically recognize your share of the earnings. But if you own less than 20%, you only record the dividends you receive, not your share of the earnings that the company keeps for reinvestment or other purposes.
I see. So if Berkshire owns, say, 15% of a super profitable company that's reinvesting most of its earnings, those retained earnings wouldn't be fully reflected in Berkshire's own reported income.
Exactly. And Buffett knows that the value of an investment isn't just about the dividends you get in the short term. Those undistributed earnings are still building up the value of the business, which Berkshire partly owns.
So you need to look beyond just the standard GAAP numbers to get a complete picture of Berkshire's true economic performance.
Yes, Investors might have to do some digging, maybe do their own calculations to figure out things like look-through earnings or owner earnings, which we'll talk about later. It's about being an active, critical reader of financial statements.
Not just taking the numbers at face value, it sounds like he wants investors to think more like business owners, focused on the underlying economics. Now, Berkshire has a very interesting shareholder base. Many of them have been around for a long time, right?
Oh yeah, it's very unique. Buffett often points out that a huge percentage of Berkshire shares are held by the same individuals and institutions year after year. They're long-term owners.
And that must have a huge impact on how Berkshire runs its business and communicates with investors.
Absolutely. Having a long-term shareholder base like that allows them to focus on building real value over time without worrying so much about those short-term stock market swings.
Less pressure to meet quarterly earnings expectations and more freedom to think about the long game.
Exactly. Buffett even uses the analogy of a restaurant attracting its specific clientele. He says businesses, through their actions and communications, kind of attract the type of shareholders they want.
So if a company is always hyping up short-term results and stock prices, it's probably going to attract short-term-minded investors.
Right. Whereas Berkshire, by consistently treating its investors like partners, focusing on long-term value, and being transparent about its businesses, has built this incredible base of patient, understanding shareholders.
It's like they cultivate the kind of investors they want. And he also talks about how it's impossible to please every type of investor, right?
Yes, he makes his really astute observation. No single company can satisfy the desires of all investors. Some want high dividends, some prioritize long-term growth, and others just want to see the stock price skyrocket.
And trying to do all those things at once probably won't make anyone happy.
Right. And he's really skeptical of companies that are constantly promoting short-term earnings forecasts and overly optimistic growth projections.
Because it's just really hard to predict those things with certainty.
Exactly. Businesses operate in complex, ever-changing environments. Smooth, predictable earnings growth is very difficult to achieve, even for the best companies. Buffett and Munger, they admit they can't predict Berkshire's own earnings a year out, let alone a quarter out.
And they're suspicious of CEOs who act like they have a crystal ball, who always seem to hit their earnings targets precisely.
Yes, because that can be a sign of either undue optimism or maybe even some manipulation of the numbers.
So take those rosy forecasts with a grain of salt. And what about when you're looking at a company's financials and you just can't understand the footnotes or the management's explanations?
Well, Buffett's advice is don't assume it's your fault. Often, it's intentional. He even talks about how he was confused by some of Enron's disclosures before it all came crashing down.
So if the explanations are overly complex or opaque, that's a red flag.
It often is. Stick to businesses that are clear and straightforward in their communications.
Makes sense. All right, let's move on to boards of directors and the people running companies, managers. Buffett has some interesting thoughts on corporate governance.
He does. He points out this kind of ironic situation. It's often easier for an incompetent CEO to keep their job than it is for an incompetent employee at a lower level.
Because if you have a secretary who can't type, that's pretty obvious, right?
Exactly. But judging a CEO's performance, especially when it comes to long-term strategy, is much more complex and often much more political.
And he talks about the boardroom atmosphere as a big part of the problem.
Yes. He describes these boards as often filled with very polite, agreeable people, where it's just really hard to challenge the CEO to ask those tough questions.
Like, is this acquisition really a good idea, or are we paying our CEO too much?
Exactly. It can feel socially awkward, like you're breaking some unspoken rule, and challenging the CEO's compensation is almost unheard of.
So it's less about the formal rules and more about the human dynamics, the social pressure to not rock the boat.
Right. And while Buffett sees some value in corporate governance reforms, he's also a bit skeptical that more rules are always the answer.
It's about creating a culture of true oversight, not just going through the motions. So what does Buffett see as the most important roles for himself and Charlie Munger at Berkshire?
He boils it down to two key things. First, attracting and keeping those amazing, ethical managers to run their businesses. And second, making smart decisions about how to allocate the huge amounts of capital those businesses generate.
And once they've got those great managers in place, how involved are they in the day-to-day operations?
Not very involved at all. They give those managers a lot of autonomy. Buffett even says, imagine if your job was to manage a golf team, and you had Jack Nicklaus or Arnold Palmer playing for you. Would you try to teach them how to swing?
I don't think so.
Exactly. They trust their managers. They give them a simple but powerful directive, Run the business as if you were the sole owner, as if it was your family's only asset.
And to not let short-term accounting gimmicks drive long-term decisions.
Exactly. That's a powerful message. And speaking of incentives, what about executive compensation? Stock options are so common these days. What's Buffett's take on them?
Well, he's not a fan, to put it mildly.
He really criticizes the overuse of stock options as the main way to motivate managers.
And why is that?
He points out that shareholders and option holders have very different risk profiles. Shareholders have their own capital at risk. Option holders, on the other hand, with their fixed exercise prices.
They don't face the same downside.
Right. They don't have the same skin in the game. And he even tells this story about a company trying to renegotiate warrant terms with the government, arguing the government was making too much profit.
From a bailout, I assume.
Yes. But they were seemingly oblivious to the huge profits their own executives were making from their stock options.
So the incentives can be misaligned. How does Berkshire approach compensation differently?
Their system is all about rewarding managers for the performance of the specific business unit they control. So the manager of See's Candies isn't rewarded or penalized based on what's happening at the Buffalo News.
Right, they're judged on their own performance.
And their bonuses aren't tied to Berkshire's overall stock price. They believe strong performance at the individual business level deserves to be rewarded, regardless of what the stock market is doing.
And those bonuses can be pretty substantial, can't they?
Oh, yes. For top performers, they can get bonuses that are many times their base salary. Buffett believes age and tenure don't matter as much as results.
If you're consistently delivering, you deserve to be rewarded, period.
And importantly, Berkshire encourages their managers to use those bonuses to buy Berkshire stock, further aligning their interests with other shareholders.
Putting their money where their mouth is. Now, what about when a subsidiary needs a lot of capital investment? How does that factor into compensation?
They factor in the cost of that capital. If a business needs a lot of investment to grow or stay competitive, there's a cost of capital charged against the manager's results. And if they're good at managing capital and returning excess funds to Berkshire, they get credit for that too.
Makes sense. You have to hold managers accountable for how they use capital. Okay, let's move on to the role of auditors, those external watchdogs. What are Buffett's thoughts on them?
He believes auditors need to be held accountable for telling the audit committee everything important, even if it's uncomfortable.
And he even has specific questions that he thinks every audit committee should ask their auditors.
Yes, 4 key questions.
Sure, let's hear them.
First, they should ask, if you are in charge of preparing the financial statements, would you present them any differently than management has?
So any differences of opinion need to be documented and explained. What's the second question?
Second, they should ask, as an investor, would you feel like you have all the information you need, in plain English, based on these statements alone?
No hiding behind jargon or complexity. And the third question?
Third, they should ask, if you were suddenly the CEO, would you change anything about the internal audit procedures?
Interesting, getting the auditor's perspective on how things could be improved. And the final question.
The final question is, have you seen any attempts by management to manipulate earnings by shifting revenue or expenses between periods?
So basically, are they playing games with the numbers to make things look better?
Exactly.
Those are really tough questions designed to make the auditors think critically.
And Buffett's point is, if you hold auditors accountable, they're more likely to do their job thoroughly and speak up about potential problems.
It's about creating that checks and balances system. Now, we know that Berkshire has a very frugal culture at its headquarters. Is that intentional?
Absolutely. Buffett sees it as a way to reinforce the idea that they treat shareholders' money with the same care they treat their own. They don't waste money on fancy offices or unnecessary expenses.
It's a signal that they're careful stewards of capital.
Exactly. And this culture extends to their compensation plans, their annual meetings, even their annual reports.
They're all designed to attract and keep the right kind of people, those who share their values.
Right. They want managers and shareholders who are long-term focused and understand the value of building sustainable businesses.
It's a culture that's been carefully built over decades. Now, let's get into the core of Buffett's investing philosophy. Value investing and the idea of a margin of safety.
This goes back to Benjamin Graham, Buffett's mentor and the father of value investing. The core idea is to buy good businesses when they're selling for significantly less than they're worth.
Buy low, sell high, in a nutshell.
Right, but with a focus on the underlying value of the business, not just the stock price. And he stresses the importance of a margin of safety, buying at a big enough discount to account for potential mistakes in your analysis.
Because you can never be 100% certain about the future.
Exactly. He even tells the story of his Washington Post investment, which he bought for a fraction of its intrinsic value.
A classic example of value investing in action. And he also talks about arbitrage, right? Exploiting price differences.
Yes, traditional arbitrage is about taking advantage of price discrepancies for the same asset in different markets. And then there's risk arbitrage, which focuses on profiting from things like mergers and acquisitions.
But even with arbitrage, which seems less risky, he stresses the need for knowledge and understanding.
Absolutely. He tells the story of an arbitrage opportunity involving a chocolate company and a quirk in tax law.
Sounds intriguing.
It was. But he also warns about the dangers of speculation, of jumping into things without doing your homework. He recounts an example where he got burned because he didn't fully understand the industry dynamics.
So even with seemingly sure things, you can't skip the due diligence. Now, another key idea from Buffett is staying within your circle of competence. What does that mean?
This is about recognizing the limits of your knowledge. Buffett uses the analogy of casinos. Casinos love high volume, but they get nervous when someone makes a huge bet that could wipe them out.
Because they know the odds are in their favor over the long run.
Right. And for investors who don't have the time or expertise to analyze individual companies, broad diversification through index funds can actually be a very smart strategy.
But for those who do have the knowledge and the time.
For those investors, focusing on a few great businesses that they understand deeply can lead to much better returns. As Mae West once said, too much of a good thing can be wonderful.
So quality over quantity. Now, we all know that growth is generally seen as a good thing for companies, but Buffett has some nuances to add to that, right?
Absolutely. He says growth only creates value for shareholders if it's profitable growth. If a company's investing capital and getting a poor return, that's actually destroying value.
He often mentions John Burr Williams's formula for valuing assets based on the present value of future cash flows.
Right. But the tricky part with stocks is that those future cash flows are much harder to predict than, say, the interest payments on a bond.
So it's about being realistic about what you can and can't know.
Exactly. And that ties into the margin of safety again. You need to buy at a discount to account for those uncertainties. And Buffett admits he can't predict cash flows for most businesses, but he emphasizes that it's okay not to know everything.
It's about acknowledging the limits of your knowledge. And he also prefers buying stocks in the secondary market from existing holders rather than in initial public offerings, those IPOs. Why is that?
He believes the secondary market offers better opportunities for value investors because it's driven by human emotions, by fear and greed.
So sometimes stocks get mispriced, creating opportunities to buy low.
Right. Whereas in IPOs, the sellers, the companies, and their bankers, they have the upper hand and can usually get a higher price.
Now, Berkshire is known for partnering with exceptional managers. What does Buffett look for in these people?
He admires managers who are not only skilled, but also have incredible integrity. He often talks about his investment in Capital Cities ABC and his respect for Tom Murphy and Dan Burke.
He famously said they were the kind of men you'd want your daughter to marry.
Exactly. Character and ethics were just as important to him as their business acumen.
And even with great managers in place, patience is still key, right?
Absolutely. As he says, you can't produce a baby in 1 month by getting 9 women pregnant. Some things just take time.
And speaking of time, Buffett often talks about economic moats, those durable competitive advantages that protect a company's profits over the long term.
Coca-Cola is a perfect example. Its brand and its distribution network are incredibly difficult for competitors to replicate. Buffett points out that Coke's 1896 annual report already emphasized the importance of brand building and distribution.
So some things never change.
Right. And he calls businesses like Coke the inevitables. Their long-term success is almost a foregone conclusion.
And on the other side of the coin, Buffett avoids those fleeting fads and speculative bubbles.
He's very wary of those. He cautions against following the crowd and stresses the importance of thinking for yourself. He even quotes Keynes, who said it's usually better to fail conventionally than to succeed unconventionally.
Meaning it's okay to be different, to go against the grain if you believe in something.
Exactly. And he's also against trying to predict macroeconomic factors like interest rates or the stock market. He focuses on understanding individual businesses.
Back to the fundamentals. Now let's talk about the difference between intrinsic value and book value.
Intrinsic value, as Buffett defines it, is the present value of all the cash a business can generate over its lifetime.
Sounds like a mouthful.
It is. but it's basically a way to estimate the true worth of a business based on its future cash flows. And it's just an estimate, not an exact number.
And book value.
Book value is a simpler accounting measure. It's the difference between a company's assets and liabilities.
So what it's worth on paper.
Right. But book value can be misleading, especially for companies with a lot of intangible assets like brands or patents, or for businesses carried at historical cost that might be much higher or lower than their current value.
He uses Berkshire's old textile business as an example where book value didn't reflect reality.
Exact.
So what should managers be aiming for when it comes to retained earnings and their impact on market value?
Buffett's view is that managers should strive to make sure that every dollar of earnings they keep and reinvest in the business translates into at least $1 of added market value for shareholders.
So retained earnings should be put to good use.
And he talks about this idea of St. Offset, where the really great businesses in a portfolio can make up for the weaker ones.
It's like a team effort.
And for investors, he encourages calculating their own look-through earnings, their share of the earnings from all their investments, to think more like business owners.
No, what about economic goodwill?
This refers to the value of things like a strong brand, a loyal customer base, or a dominant market position. It's what allows a company to charge a premium for its products or services.
Because people are willing to pay more for a brand they trust or a product they love?
Exactly. And he contrasts this with accounting goodwill, which is an intangible asset that arises when one company buys another. The accounting treatment of goodwill can be complicated, and Buffett prefers a simpler approach. Record the acquisition cost, and don't amortize goodwill unless there's clear evidence that its value has been impaired.
Keep it simple. Now let's revisit owner earnings, that metric we mentioned earlier.
Owner earnings is a way to measure the true cash a business generates for its owners. It starts with reported earnings, adds back non-cash charges like depreciation, and subtracts the capital expenditures needed to maintain the business.
So it's a more realistic view of the cash flow available to owners.
Right. And while calculating those maintenance capital expenditures requires some judgment, Buffett believes owner earnings is a much more useful metric than GAAP earnings, which can be distorted by accounting rules.
Now, given how complex accounting can be, Buffett has some strong opinions about manipulating earnings.
He does. He even jokingly proposed a new accounting system where employee compensation would be completely eliminated from the income statement.
Sounds like a recipe for disaster.
It was meant to be satire, to highlight how accounting can be used to create a misleading picture of a company's performance. He also discusses the debate over expensing stock options and criticizes the practice of using restructuring charges to manipulate earnings.
So be wary of those one-time charges.
And focus on the long-term trends in book value and operating earnings, not just the quarterly fluctuations in reported net income.
Solid advice. What about taxes? What are some key insights there?
He explains the concept of a deferred tax liability on unrealized gains. It's not a cash outflow today, but it's like an interest-free loan from the government that you'll have to pay back eventually.
And how do tax changes affect different businesses?
Companies with strong, unregulated earnings power tend to benefit the most from tax cuts, while those in more competitive or regulated industries often see the impact pass through to prices.
And for individual investors, the tax benefits of long-term holding are significant.
Absolutely. The less you trade, the less you trigger taxable events, and the more your investments can compound after taxes. He gives those great examples showing how much wealth can be eroded by frequent trading.
So patience pays off in more ways than one, and there's also a tax advantage to owning more than 80% of a company.
Yes, dividends from wholly owned subsidiaries aren't taxed at the parent company level. That's a big plus for Berkshire.
Now, Berkshire is a conglomerate, and conglomerates haven't always had the best reputation. How does Buffett explain why Berkshire is different?
He acknowledges that conglomerates have often deserved their bad reputation, especially those from the 60s and 70s that used inflated stock prices to buy up unrelated businesses. But he argues that Berkshire is different because of its unique system and his long-term focus.
It's not just a random collection of companies.
Right. He talks about the importance of rationality, win-win deals, decentralized management, and the transmission of wisdom within the organization.
It's a culture that's been carefully built over many years.
And he also stresses the importance of having a thoughtful leader who avoids bureaucracy and attracts the right kind of talent.
Does he think other companies can learn from Berkshire's success?
He does. He encourages them to emulate some aspects of Berkshire's system, especially when it comes to minimizing bureaucracy. He compares unnecessary bureaucracy to a disease that needs to be treated aggressively.
So keep it lean and efficient. Now, has Berkshire's enormous size made it harder to find good investments?
Yes, he talks about the challenge of size, what he calls managing Methuselah's estate. Finding investments that are big enough to move the needle for Berkshire is much harder now than it was in the early days.
But they're still sticking to their core principles.
Absolutely. They haven't changed their approach just because they're bigger. They're still looking for those high-quality businesses at the right price, just like Ted Williams waiting for the perfect pitch.
Okay, before we wrap up, let's quickly define a few terms that Buffett uses a lot.
Sure. Cigar butt investing is about buying very cheap, distressed companies, hoping to squeeze out one last profit. Buffett learned to move away from that approach toward investing in higher quality businesses.
Got it. What about circle of competence?
That's the boundary of your knowledge and understanding. It's important to stick to what you know.
And the dividend test.
That suggests companies should only retain earnings if they can reinvest them profitably. Otherwise, they should pay dividends.
And finally, double-barreled acquisition style.
That describes Berkshire's two main ways of buying businesses. Either 100% of a private company or a large minority stake in a public company.
All right, great. So as we wrap up our deep dive into Buffett's essays, what are the most important lessons for investors and managers?
The key takeaways are really about thinking long-term, understanding the value of businesses, investing in companies with great managers, and avoiding speculation and excessive trading.
It's a framework for making smarter, more disciplined decisions.
Exactly.
So, the learner, here's something to think about. How can you apply these principles to your own investing or your own business? What are those one-foot hurdles in your life that you should be focusing on? Those things that are within your control and that you can consistently do well.
Because ultimately,